Coming up next is our panel Climate and Nature on the Brink. What does it mean for banks? We welcome the speakers to the stage. This panel will discuss how we can address the risks from climate change and nature degradation. The Vice Chair of the ECB Supervisory Board, Frank Elderson, will moderate this session. Frank co-chairs the Task Force on Climate-Related Financial Risks of the Basel Committee on Banking Supervision, and as you all know, he is one of the most outspoken ECB voices on climate and nature. Frank will introduce the panel members, and there will be a Q&A session to address your questions.
All right, well, good afternoon to all of you and welcome back in this room. I hope you had a good lunch and you digested also what I thought was a wonderful panel, which set the bar very high. But I am here accompanied by some wonderful panelists whom I will introduce to you in a minute. So earlier today, we discussed how banks are navigating an increasingly uncertain world, marked by rapid technological advancements, geopolitical tensions, and cyber risks. Now, building on these insights, we will now turn to explore the climate and nature crises that are intensifying the risks that are faced, that the financial sector faces. And as supervisors, it is our job to ensure that financial institutions remain sound and resilient. Climate and nature risks are no longer theoretical or distant. They are here today, and they will only become more severe and multifaceted over time. From extreme weather events to irreversible climate shifts, these risks are reshaping industries, disrupting supply chains, altering asset valuations, and even questioning the very habitability of entire regions. Now, in this context, banks face a dual challenge. First, they must manage the risks posed by climate change and nature degradation, a task that is indispensable to ensure their own resilience. And second, they are key to supporting the transition to a low-carbon economy. A strategic opportunity, and I hope we will be able to talk about that word as well, a strategic opportunity that, if approached thoughtfully, can strengthen their competitiveness and long-term sustainability. Now, the extent to which banks effectively integrate climate and nature risk into their strategies, their governance, and risk management will not only shape their own future, but also that of economies and society at large. Now, today we will explore three core themes. First, the progress that banks have made in embedding climate and nature risks into banks' risk management frameworks. Two, the increasing financial costs of climate change and strategies to address those. And third, the untapped potential and business opportunities in the green transition. Now, today we are truly privileged to have with us three distinguished panelists that have much in common, but the thing that they have most in common is that they are truly intellectually honest people. These are the people that talk truth to power, and if I have a little bit of that, they talk truth to me, but they also go relentlessly where the evidence takes them. A wealth of experience that I'm sure will lead to a rich discussion. So let me briefly introduce them. Michala Marcussen, Group Chief Economist and Head of Economic and Sector Research at Société Générale, who brings extensive expertise in understanding the financial sector's response to climate risks. Kevin Stiroh, a Senior Fellow at Resources of the Future and former Executive Vice President of the Federal Reserve Bank of New York, a leading authority on banking supervision and climate-related financial risks. And Patrick Amis, Director General of Specialized Institutions and LSIs here at the ECB, who has been at the forefront of efforts to advance the integration of climate and nature risks into banking oversight at the ECB. So together, we are going to assess where we stand, the challenges ahead, and the opportunities for banks and supervisors to act decisively in addressing these risks. So let's dive into our discussion. And to set the stage there, let's begin by assessing where we are today. So over the past years, there has been notable progress in how banks integrate climate and nature risk in their governance and risk management frameworks. And I've said this before publicly, and I will say it again today. I thank the banks for that progress that has been made over the last 5 years. I think it's notable, and I think it was necessary, but I know that so many people have worked so hard to get all the banks and then the specific banks where they worked in, from A to B, and the progress has been notable. It has been driven not only by regulatory requirements, but also by growing market expectations and the increasing visible impacts of physical and transition risks. So Patrick, I've talked too much already. I'm going to start with you. So we would like to hear what you think are the most common challenges that you see banks facing when it comes to effectively embedding climate and nature-related risks into their governance and risk management processes.
Okay, many thanks, Frank. And maybe at the risk of repeating some of your introductory words, let me start this question on challenges with progress. Because I think it's fair to say, and I think it's important that we repeat it, we have come a long way since 2019, where we started surprising a bunch of banking officials with those strange questions on climate. And we have had tremendous work. It was a steep learning curve, but I think we have now the fundamental building blocks in place in terms of risk identification, risk monitoring, risk management in the banking industry, at least in the SSM, to be sure that we can continue progressing and addressing remaining challenges. And it is very important because it shows that when we set to it, we do progress collectively. And I think this is really a message we want to repeat time and time again. There is a way, and we have been seeing a lot of progress across the board. So it doesn't mean that everything is done and achieved. We have a lot of things to do, a lot of remaining challenges. And maybe if I try to quantify or qualify them in three main blocks, I would say the first one is inconsistent and incomplete risk coverage. So we have pushed banks into a very detailed and thorough risk identification, but we still see that in a number of cases we have banks that are pretty good at looking at transition risk, but are failing still to really onboard risk identification for physical risk, for instance. We have a lot of banks that are still struggling to get data on energy performance certificates, which are particularly relevant when you start thinking of collateral valuation for real estate risks. So these are topics where we see that these inconsistencies across risk factors, across geographies, across exposures are remaining, and we will continue pushing the banks towards deepening their risk analysis. The second area of challenges from my perspective is gaps in risk quantification. And we see this in particular on ICAP assessments. We, as part of our journey towards moving the banking industry towards a sound integration of climate and environmental and nature risks into the risk management processes and their governance and risk appetite, we still see that from an ICAP perspective, this is in infancy. And we need to continue seeing progress in the way banks will incorporate climate and nature risks into their ICAP. This is the same for stress testing as well. And so, of course, one of the reasons for this is remaining data gaps. So we tend to say very often that data gaps are more a matter of demand than a matter of supply, meaning that when we start being in need of data, we look for them and they start appearing, and over time, methodologies, data gathering crystallize, and we start getting to market standards, and this is improving. If no one is asking for it, this is not progressing. That being said, we still have, of course, data availability issues in terms of geolocalization of physical risks, for instance, and also in tagging climate and nature risks in loss events, which is a critical element for us if we want to continue progressing with respect to further incorporation of climate and nature risk into this quantification of risks. We need to have a better ability to tag the source of losses. A bank knows when there is a default on a mortgage. Whether the default on this mortgage is coming from a flood event somewhere in their portfolio is something that is still a little bit under construction, I would say. And finally, the third area of challenges for us is the still insufficient integration of climate and nature risks into the stress testing frameworks of the banks. So to be fair, we now have all SSM banks with some form of stress testing capability incorporating climate and nature. But it's far from being enough, and we will also continue pushing on this one.
Thank you very much, Patrick. Michala, I'm going to go to you now. So from your perspective, how would you assess the progress that banks have made in identifying and embedding climate and nature-related risk into their risk management frameworks? And do you think, or do you see any areas where you think there's actually room for improvement?
So to my mind, I think what's really important to appreciate is how these risks have been evolving over time. Frank, you started by saying it's no longer something distant. It's something that we see. We see an increased frequency of extreme weather. We also see, and I think it's very important to be mindful here of, increased volatility in climate policies. Climate policies are complicated, they're difficult, and they can change with political environments. We see this even in Europe. We've seen a little bit of a pullback prior to what we saw on our own ambitions here in Europe. And I think the complexity is both on the extreme events, but also in terms of the climate policies. And I think just drawing back to our discussions this morning on the geopolitical risks, we see how environmental risks, climate policy risks, transition risks can also be embedded with the geopolitical risks. And to my mind, it's not about developing a risk management framework to manage this risk, and this risk. I think everyone in the room would be very surprised if I told you I have a dedicated process to managing the risk of monetary policy. No, it's part of a macro policy risk, and I think this is how we should think about all of the risks that we face today, especially as we see they become more intertwined. So I think a first area which is important to be mindful of is this taking an integrated view rather than thinking about things in isolation. Secondly, I think there are a number of risks where we can still enhance our understanding, because I think it's the important, and you said this as well, it's about understanding the risks. And I think there are areas, especially in the area of nature, where it's important to have a deeper understanding. You mentioned, Patrick, that a lot of the climate data is stronger. Nature data is still much more complicated. And then I think one of the biggest challenges we face, and this was mentioned as well this morning, is in how we can think about risks that have not always materialized yet. And that means that historical models may not be a good guide. If we think about geopolitical risks, these have changed dramatically in nature. Previously, they were more country-specific, more isolated. And now we're seeing something which is crossing borders, and we heard about it this morning. And that means that we have to think differently also about how we think about models. I'll say the big word, expert judgment, probably because I'm an expert myself. I like to have expert judgment. But I think there's a little bit of a need for bringing back some expert judgment here and accepting that that's something that can be part of the framework. And then I think what was also mentioned this morning, so I'm repeating a lot of what was said this morning, but in many ways I think that in terms of the risk management framework, there are lots of things that come together. I think about agility and reactivity. This is very important. Mm-hmm. But at the end of the day, the banks, we're here to serve our clients. And this has to be a key goal that we work towards. And of course, to manage the risks that those clients can put on our institutions and the risks that we face more broadly, of course, as well. So to me, it's about bringing these combination of things together. So sometimes I think granularity is good, but sometimes I think we also have to be careful not to miss the big picture. I'll give you an example. You can sit and you can look at a small geographical area and you can think maybe this is an area that's exposed to flooding risk. Maybe you've had floods happening there. But what happens if the street up the road is flooded? Do you understand that then you can no longer maybe get to the factory? Do you understand that something could happen somewhere else? So sometimes we can also get lost in the granularity. And I think we also have to try and have a big picture, holistic approach. And then once we've done all this granular stuff, is the client insured? And is there a risk that that insurance goes away? So sometimes I also think we find safety in the granularity and buying lots of data, and I love data. But I think this is something we need to focus on, building more of a big picture view.
Thanks a lot, Michala. So Kevin, talking about expert judgment, I'm going to ask you about your expert judgment, and more specifically on what you see as the most effective regulatory and supervisory tools to ensure that banks adequately manage their climate and nature-related risks and integrate them also in their business decision-making and capital allocation.
Yep, great. Thanks, Frank, and thanks very much for the opportunity to be here. So I'm going to take a step back and start at the beginning. Why do supervisors care about the financial risks of climate change? In general, supervisors expect firms to manage all material risks, whether it's a business cycle, a geopolitical risk, a cyber event, or climate-related risk. And that's because banks play this key role in providing credit to the real economy. The challenge for supervisors is that climate-related risks might have distinctive attributes that require additional focus, additional expertise. So what are those attributes? The impacts of climate change are likely to be secular and wide-reaching. They're not cyclical and narrow. There's massive uncertainty. We talked about this topic this morning around geopolitics. So that means you need a different approach that is that builds resilience, that is more robust to a wide range of outcomes. And as was just mentioned, the past is unlikely to be a good guide for the future. So you need new data, new models, new expertise. So those are the challenges that supervisors face. So what I've observed when this works well is to be really clear about the objective of why supervisors are engaging. You'll notice I haven't used the word mandate at all. I haven't talked about the green transition at all. I've talked about ensuring effective risk management of shocks that could disrupt the banking system's ability to provide the critical financial services. I think you also need to be flexible. When there's lots of uncertainty, that means there's room for errors, that means there's room for unintended consequences, and this needs to be an iterative process as both the supervisors and the banking system learn about these risks and learn about the best ways to manage them. So that's the third thing that seems really important, is engagement between the official sector and the private sector through conferences like this one. And when Frank and I were co-chairing the Basel Committee's task force on climate-related financial risks, one of the most effective things we did was a series of outreach sessions with bankers from around the world, because the private sector faces a different set of constraints, they have different objectives, they might face different trade-offs. And bringing that perspective together will make any supervisory approach more legitimate and more durable over time. And then finally, I think a really important point was just raised. Anything to do with managing climate-related risks needs to be embedded in the overall enterprise risk management framework. It makes no sense to think about climate over here and manage other risks over here. And that's the framing I think that was so useful in the Basel Committee's work and also this morning, the phrase risk driver. Climate is not a new risk. It is a driver of existing risks, credit risk, market risk, operational risk, et cetera. And understanding that transmission mechanism, given those distinctive attributes, is the challenge I think that we all face.
Well, thank you, Kevin, and it just reminds me of these many hours that we were co-chairing that task force together, which was a great treat. Maybe this is a good moment, according to this clock, 8 seconds too late, but still, to transfer to the next set of questions. That's another way of saying that we are doing very good on time, actually. So as climate change accelerates, the financial implications for banks and the broader economy are becoming more severe, including the costs from physical risks like natural disasters and transition risks like stranded assets. Now, one of the critical challenges that we all have to face is that traditional risk transfer mechanisms, such as insurance, may no longer always be available to absorb these escalating costs. So this gives rise to urgent questions. So how do banks and society then actually bear these costs without undermining financial stability and economic growth? So maybe now I'll work my way back from Kevin, William, Michala to Patrick. So Kevin, how should banks prepare for the rising financial costs of climate risks manifestation, particularly in a scenario where insurance may become increasingly limited?
Yeah, so that's a very timely question. And as several panelists have already said, this is not a 2050 event. This is a today event. And we see dramatic changes in the insurance market, for example, in the United States. So I'll think about how climate-related impacts flow through to the banking system. And there are a number of factors that will determine that. So frequency and severity of shocks, the value of structures that are impacted, the efficacy of adaptation investment. Then you need to think about the bank's actual exposure. Where have they made lending investments? Where do they hold securities? There's a series of mitigants, including insurance, including government support. And then there are a number of amplifiers that can take a small shock and make it a bigger impact. So those are all the types of things a bank needs to factor in when trying to think through the impact on its own balance sheet, its own income statement. In terms of insurance, there is a large and growing academic literature looking at the impact of climate change through insurance markets and banking. And you find, the papers find exactly what you would expect. In the US, in regions where the physical risks are greater, you see insurance premiums rising, you see insurance providers pulling back, you see a greater increase in underinsurance, you see higher non-renewal rates, and all of that translates to the banking system. And again, the academic evidence shows in those regions, you see higher delinquencies, you see faster prepayments, and these are risks that banks need to manage. So if I'm thinking from a banker's perspective on the role of insurance, what do you do about that? So the first thing is you make sure you're monitoring the risks and observing what is happening in terms of the providers of insurance, the prices that they're charging, how they are capitalized, are your insurance counterparties well diversified, for example. Another thing is to work on the data that you need to assess these risks. So last year, the Federal Reserve did a pilot climate scenario analysis that looked at the impact of physical and transition risks. And one of the things that work identified was data gaps specifically related to insurance, around replacement cost values, around the types of coverage around the deductibles that their borrowers had. So ensuring that that information is timely and comprehensive is critical. And then the third piece would be to continue to work with the borrowers on how are they preparing for climate-related risks in a way that would offer greater protection. Are they making investments in adaptation? Are they thinking about their own transition risk and incorporating those into the bank's risk management approaches?
Thank you, Kevin. Very clear. Michala, so thinking beyond insurance, is there any other alternatives that you see? Could scaling up adaptation finance play a prominent role in fostering resilience?
So I think Kevin mentioned this at the end of a long list that I agree with, but I think this is very important. The banks, as I said earlier, we're here to work with our clients, and we can help our clients as well on adaptation. This is unfortunately something that we're going to have to do much more of, given the direction we're heading in at the moment. And I think we have an important role to play here. But I also think it's very important that policy is there as well, because I think between the supervisors and the banks, there are things we can do, but if you don't have public policy, think about Tokyo, okay? So I grew up partly in Tokyo. Nobody is that worried about all of the houses falling down where there's an earthquake, because there are strong building standards. So there has been adaptation to earthquakes. So I take this as an example. We see horrific things happening when there are earthquakes in areas where the adaptation has not been done. And so I think adaptation, it doesn't fix everything, absolutely not, but it can be key. And I think having policy in place to support the adaptation is incredibly important, because adaptation, it's a cost avoidance investment, as opposed to the type of investment where you're hoping to make a huge profit from the investment itself. So it's a different investment in terms of its structure. Cost avoidance can be extremely important, and it can be a question of survival for companies. But I do want to emphasize that policy dimension.
Thank you very much, very clear. And we Dutch know a little bit about adaptation. We've been building dikes in the Middle Ages, etc. There comes a time that maybe the sea gets too high. So Patrick, it's time to transition to something I know is very close to your heart, which is transition plans. As banks are growing, are facing growing physical and transition risks, how can they actually develop robust transition plans that do not only reduce their exposures, but also account for the evolving limitations of what we talked about earlier, traditional insurance?
No, many thanks, Frank. And I think I fully agree with what was said before. And in particular, it's very clear that we supervisors and the banks are not the only game in town, basically. That's for sure. I think from time to time, we would like also to remind ourselves that not being the only game in town doesn't mean that we should not be playing. And we should not also over-rely on public finance, for instance. And this question of adaptation finance, to me, is a critical element also of transition planning, of sound markers of transition planning for the banking industry. Maybe let me start with a few points on transition planning. First, when we take the EBA guidelines, and we need to start from this perspective, we see that the vast majority of what is in the EBA guidelines was de facto already covered very largely by the ECB expectations published in 2020. And for very simple reasons, because the EBA guidelines on transition planning are being built upon the traditional markers of sound risk management. And here I fully agree with Kevin. We are supervisors. We care about risks. And this is what we really pushed for in the last 5 years. So it means the good news is that a big part of these EBA guidelines is already well in train and well known by us and by the bank. So that should make things very easy. We have a number of novelties around portfolio alignment, around profitability in particular, around expectations with respect to customer engagements. That are the novelties a little bit we need to think about. And we are going to do this recognizing that it is complex, and we are going to do this taking a little bit our time to better understand the challenges that are out there in the banking industry, do this in dialogue with the banking industry, and meaning that we are not going to start enforcing whatever on the 1st of January 2026. I think there is an excellent piece of blog from a colleague right next to me that was published mid-July on our website that explains very precisely how we intend to go about it, that I would recommend reading in that context. So we will be taking our time, discuss with the industry, with the banks, try to gather information, and then move on. But we will do this in very strong dialogue. One important topic, we will concentrate on climate and nature risks. The regulation and the guidelines speak of ESG. And we actually believe that if we want to do a very good job, a sound job on the different markers or components of ESG, that is actually very different methodologies, conceptual backgrounds, and so on and so forth. And so we will concentrate on climate and nature. And if you allow me a bit of a joke, these days when we see ESG, we tend to read environment, security, and geopolitical risks. So that's something that we will continue looking at, focusing again on climate and nature. Another important element, it is not our mandate to tell banks to which sector or company they have to lend. We're not going to do this. It is our mandate to make sure that banks do have a sound understanding of the risks they take when they lend to a sector, a particular sector, or a particular company, and that they do incorporate that in all the different components of the risk management framework, risk appetite framework, including profitability and capitalization via their ICAP systems. But we will not be the ones telling them where to lend. And that's, I think, a very important topic. A few key markers we can already identify, and we are not going to go further than that right now because, again, we want to discuss with the banks. But a long-term perspective is critical. We are not going to look at the picture on any given day. We are more interested in the cinematic. And so we will be looking at these particular features of transition planning. Transition is a cinematic movement, and we want to see how banks look at this. It does not mean that we will be particularly interested in a point-in-time picture. Customer engagement will be super important. And all the more if we see that it's sometimes it might become a little bit more difficult to get customer information from regular reporting. It will depend, of course, on the outcome of a few legislative developments, but customer engagement will become even more important in that context. And finally, to the point of Michala, adaptation finance. How do banks look into adaptation finance? Because this is not only a risk management question, this is also a future profitability question, and this is also an opportunity for the banks.
Well, thank you very much. So to just manage expectations a little bit, we are now entering our third block. We have 11 minutes and 11 seconds for that, and then it's time for the audience. So if you're getting slightly bored at one point, start thinking about the questions you want to ask, but I think actually that's impossible to get bored because you just made some statements that if I were the wires, I would pick them up, Patrick. So that was all very good. Now, if you have some word cloud over you now hanging, there's lots of, big risk words there. And I think it's time to start adding to that word cloud opportunity. And you already mentioned it, and some of you at one point did as well. Because the green transition does not just present challenges. It is also significant business opportunities for the financial sector. With annual investment needs estimated to range from 738 billion to 1.2 trillion to meet EU climate goals alone. So banks are at the forefront of the financing of this transition, and we are already witnessing encouraging developments, such as green bonds generating more fees for banks than fossil fuel deals. I'm not going to repeat that, but that little pause, I just thought it was nice to say. It's just fact. Making a key turning point for the financial sector. But there are many other examples. Patrick, we are increasingly seeing how some banks are actually positioning themselves as leaders in the green transition by adopting strategic, long-term approaches to financing sustainable development. Now, from your perspective, what specific practices or innovations set these banks apart? And how can supervisors and maybe slightly less advanced banks accelerate efforts to unlock new growth opportunities?
Okay, yeah, and I will be faster, I promise, on the third answer. Very quickly, what we have been seeing across the board when we scan the bank's practices, if I try to categorize, one thing we see as a distinct feature is leveraging on the strategic value of stress testing and embedding the outcome of stress testing into strategic discussion and influencing, informing capital and portfolio allocation at the end of the day. Very clearly, we see a number of banks that are already reasonably advanced in that direction. And we think this is a very good practice. The second element we see is commitments to improving data availability and data quality. So we see also a number of banks really going into a very detailed structure of internal quality assurance on data. So being able to use deep proxies, let's put it like that, where they are missing something more refined, and moving the data quality or the quality assurance ladder as they progress, and having very structured frameworks around this, and experimenting with data sources and crystallizing their methodologies as they move, and making use of this for probably superior decision making. The third element is working further towards comprehensive quantification, and this one, of course, is a very difficult topic for not last for one of the reasons mentioned by Kevin, which is the fact that these risks are not cyclical; they tend to be, of course, a little bit exponential. And that means that quantification is only, and data gathering and loss history is only the first step. You need to see to anchor and ground your methodologies, but then you need to progress further in terms of quantification. And we see a number of banks that are already doing this. And perhaps the last point is nature risks and progressing on nature risk identification. This is a little bit the new frontier we have. We're not going to do anything specific on nature, so we are onboarding nature into our climate and environmental risks framework. And I fully agree also with Michala that at the end of the day, we are not inventing a specific framework for yet another category of risks. And I was super happy recently, we were talking to a bank with respect to geopolitical risk, where the Stiroh in front of me said, well, it's very simple, we are reusing the framework we developed for climate for geopolitical. And this is exactly the type of synergies that we want to see. And I stop here.
Thank you, Patrick. Michala, banks often express their support and their willingness to help with the transition, but then what we hear is that many times they cite a lack of viable projects with an appropriate risk-return profile. So how can banks then actually strike the balance between short-term profitability pressures and the long-term investments that are needed to drive a sustainable transition?
So I think if we look at the European banks, many of us are over 100 years old. So if we were just focusing on very short-term profitability, we wouldn't be able to boast of being so old. And I think at the end of the day, I think the banks are really not thinking about a trade-off between short and long term, because we would like to be here for another 100 years at least. And so to my mind, profitability and viability go hand in hand. I don't see them as being opposing forces. And if we think about what makes a good investment, it's something with a good credit risk from a risk perspective, and something that helps our client build towards what they want to achieve. And that's really the business we're in here. So let's think about what's happening in Europe today. And I think the Draghi report gives us some really nice ideas about how we can combine opportunities. Because if we look at the EIB, they do a very nice survey of European companies. They also ask US companies. And when we look at the European companies, what are some of their concerns today? High energy costs, uncertainty. Those are actually the two where European companies have a much higher score of this being an issue than US companies. There are others as well, but those are the two biggest in terms of differences. And when we listen to what the Draghi report tells us, it tells us that in Europe, energy security is a key topic, energy costs is a key topic, and in our case, as we're net fossil fuel importers, that has to come from decarbonization. So this is identified not from a climate perspective, but from an energy security, energy cost, a real business question here and today. And so when we look at the Draghi report, I think if we were to implement the competitiveness compass fully, so I'm back to the policymakers again, but I think it's absolutely critical, well then we can see that this would drive a lot more investments to take us towards a decarbonization strategy. So I think it has to be about policy also working together. Just as it's not up to the supervisors to go out and tell the banks which sectors to lend to, it's also not up to the banks to go out and dictate to corporates what they should be doing. We all have our jobs to do. Our job is to manage risks and work with our clients to make sure that they can also manage these risks from their perspective. The policymakers have to give us a good policy framework, and you have to make sure we have a good, stable financial environment. Now, when all three work together in a good way, I think that's really the most important thing. So, to my mind, we need to listen to what the companies in Europe tell us, what their issues are. And we have Mr. Draghi, who has done a fantastic report. And now, all we have to do is make sure that happens. So, I think there's a lot of opportunity. And I will just say, we often criticize in Europe, we're very critical, but I think right now we see quite a positive momentum in Europe. There's still a lot of work to do on delivering. And then a final point I want to make, because I cannot go to a panel without mentioning the Savings and Investment Union, or call it Capital Markets Union, whichever name you prefer. Because at the end of the day, what do banks do? Banks lend money. We deliver credit. We do not deliver capital. And if we really want to have the technologies that we need, and this is true for adaptation, it's true for energy, it's true for many, many topics, we need to have much more risk-willing capital in Europe. So I think developing the Capital Markets Union, and again, Mr. Draghi put it in his report, you'll think I'm a big fan, I am. So it's very important that we have all of these engines working together.
Well, thank you very much. And, there is always, singing the praises of a former president of this house in this very house. is great, and actually those who have followed up in his footsteps in the board, we have been very, very vocal that we could not agree more with what you just said. Capital Markets Union, Savings and Investment Union, completing the Banking Union, taking away the barriers to the internal markets. There are so many things that are just really in our hands. There's many things that we talk about today that we cannot influence directly, but this is something that we have in our own hands, and it has huge opportunities for growing competitiveness in Europe. Kevin, as banks are then actually increasingly pursuing opportunities in the green transition, how can then supervisors ensure that robust risk management practices are maintained and climate and nature risks are adequately priced to safeguard that longer term financial soundness?
So I think we are all in violent agreement on many of the questions that you've asked, so I'll just make 2 quick points in the interest of time. So one, over the last few years, I've seen a shift in language, which I think is very constructive, away from promoting green finance to financing our clients' transition. That is the job of what banks need to do, and they need to do that in a well-controlled, risk-managed way, but that's their role. And then the second point, which we haven't really talked about, but I think is important from a supervisory perspective, is all of these, the risk management steps, the opportunities, is likely to be very heterogeneous and impact different banks in different ways, given their business model, given the risk appetite that their boards of directors set, given their geographic location and the perils that they face. So I think it is important to ensure that any supervisory perspective has to account for those idiosyncrasies. This is not a very simple problem. It's a really complex problem that requires a deep understanding of the firms themselves.
Thank you so much. But this is not my closing remarks, because now we're going to open up to the audience, both here in the room and also, if I understand how this thing works, virtually. So I'm looking around, and I see a hand right there. So, and you start, please.
Hi, thank you very much to the panel for a great discussion so far. My name is Kate Levick. I work for E3G, and I'm also the founding director of something called the International Transition Plan Network. So I was very pleased to hear the section all around transition plans. But I did have a question about that in relation to some of the remarks made on the panel. Michala, you talked about the role of policymakers and spoke warmly about the competitiveness compass. One of the ways that's been implemented is to unleash a widespread simplification agenda that's led to an EU vote today in Parliament that looks like it will sweep away a policymaker's tool that would have actually set a direction of climate transition for companies in setting requirements for transition plans. And there's also been substantial pressure from other major economies around some of those requirements and pressure on the EU policymakers to roll those back. So I guess my question is, the ECB and other European supervisors, they aren't the only players on the field, as Frank said, for sure. But what does it mean for the ECB and other supervisors if other players leave the field? And where is the cross-authority cooperation that we need on this? Thanks.
Thank you. Very topical question. Patrick, you want to have a first go?
Yeah. I think, what does it mean? First, I don't think everyone is leaving the field. We have a huge number of participants in the NGFS to start with, and so there is still work ongoing. And my sense is that we may have less talks around it, but it doesn't mean that the work is not progressing still. And so we will see, of course, how this develops over time, but my sense is that we still have quite some discussions, progress on the supervisory side, not only in banking and insurance as well. It's extremely vivid because of the insurance gap and so on. And we are developing more and more discussions among ourselves, cross-sectoral, to better understand how we go about it. And so I don't think we have a complete setback of everything. This is a little bit less vocal for a number of reasons that we all understand, but this is still happening.
Michala, do you want to pitch in from the perspective of a bank, saying, okay, you know, if we have very ambitious disclosure rules in a certain jurisdiction, could be here in Europe, could be anywhere in the world, these are of course then data that are freely available, if you like, for me as a bank, which could be seen as a, something that could help your risk management. So if there's less of that, how would you deal with that?
So when banks engage with their clients, we're used to engaging in terms of their risks and trying to understand them. We don't always have exact data points on all of these risks. We talked this morning about geopolitical risks, which could be a risk faced by a client as well. So this is something that banks are used to working with their clients on. Now, of course, the more data that there can be available, the easier that job can become. This is true. But I think what the bigger question here is, how do we deal, and it loops exactly back to what we discussed this morning, how do we deal with an environment where policy is more volatile, more fragmented, and more uncertain? And if we think about a business environment, talked about good investments, it's exactly the opposite that we need to foster economic growth. So the reality is that the banks will have to operate in this more volatile, this more complex, this more fragmented world, and continue to do, and I think Kevin said it very well, continue to do the job that we're here to do, which is also to help our clients manage these risks, because our clients face exactly these same risks, more volatile policies, things that move back, things that move forward, things that shift around, things that become more fragmented, extraterritoriality. All of these risks are risks that our clients face, and our job is to do our best to try and help them in this environment. So I think this is really, but I think this policy volatility and fragmentation, uncertainty, it's really one of the areas that's shifting in a big way. And it's not just about climate policy. We see it across the board in many areas.
You want to pitch in, Kevin?
I'll just add to that. I think the point about policy volatility is really important in two different dimensions. One over time, policies going up and down, and one cross-sectionally, policy differences across jurisdictions. And firms, both in the financial and the non-financial sectors, need to manage those changes every day. And when we would talk to the industry, one of the most common bits of feedback was the need for certainty and harmonization. And firms will adapt to anything, but it's easier if you know what it is.
Thank you. Any other questions? I'm sure there are. Don't be shy. If this was a classroom, I will just assign someone, but that's probably not how it's being done in the conference. No other questions? Any questions amongst the three of you that you heard something that you said there was quite a high level of consensus here, but maybe there was something that you would want to maybe address?
Well, I'll ask a question in that case, because Patrick, you mentioned the NGFS, and I think the NGFS has done a lot of work. We talk about things like scenarios. One of my big dreams is, when are we going to get some more scenarios on nature?
This is
so sorry to put you on the spot.
No, I think this is a very good question, and there is work ongoing actually on that topic within the NGFS. The good thing of the NGFS as well, and it doesn't mean that everything is stopping in Basel. We will probably continue having some work being done in Basel as well. But the very good thing in the NGFS environment, it's supervisors, but also central banks. And so we have a cross-sectional view from very different perspectives, micro, macro, monetary policy, and so on, that is super helpful in advancing rather novel questions like nature. And this is in particular the point for stress testing. So stay tuned.
So you're not going to give me a date?
I hope I'm not going to give you a date, but there is still work ongoing for sure.
Maybe building on this, I would have a question maybe also to you, Michala. I'll just play ping pong here a little bit. You know, as you know, it's, you know, making scenarios for climate is difficult. Making scenarios for nature is maybe even more difficult. Making scenarios that actually integrate these two are maybe even more difficult. But one thing that we all struggle with is these tipping points in these scenarios. And we now know that whereas maybe, you know, some years ago we would hope that we would, you know, end up with, you know, safely on a 1.5 degree scenario, that, you know, if we now read the latest science, that is just not going to happen. You know, the world is now on a pathway close to 3 degrees, I think now, worldwide, maybe Europe more. So the risk of tipping points occurring, and them occurring actually much earlier than we thought. And also the tipping point triggering the next one, so kind of like a domino, so the compounding effect. Is that something that you are modeling already in your bank? Are you thinking about this? Are you in the wide range of scenarios that you're trying to think about? Is this part of the thinking already?
So we have tried to look at tipping points, but it's incredibly complicated. And I think the big question mark when you're working within a bank and you're looking at risks, again, you know, coming back to what we're trying to do is we're trying to understand the risks that our clients will face. And if we're trying to understand the risks that our clients will face, there are, of course, a multitude of potential futures, and again, with many topics involved. The issue is also, if you identify a scenario in which something happens and it's uncertain, what actions can you then take from it? And that means that multi-scenario approaches are very useful because it gives you an understanding of trying to map out and see, is there something I'm missing, that the risks that this client faces that could then come onto the bank and impact us. Once you start doing scenarios about tipping points and these kind of things, it becomes very binary, it becomes very difficult to manage in terms of what concrete action you should derive from it. And Patrick, you mentioned what I think was a very important point about stress testing and about using this to inform strategy and the broader view of the group. What do you do with tipping points? It's very, very hard. It's very, very hard. That's not to say we should ignore them, but they're very difficult. And the NGFS scenarios recognize the challenges of building this into the scenarios, so it becomes incredibly hard. What's interesting is that when we talk about climate, we talk about very big systemic tipping points very often. When we talk about nature, we're talking about much more localized tipping points. And so here we get additional complexities. That's why I'm so much looking forward to the scenarios. We get these additional complexities that play in. So I think it's very, very hard. So yes, we've looked at it, but it's very hard to build in. There's some excellent work that's done on all of this, but very hard to build into models.
Thank you. Kevin?
Yeah, maybe two distinct points. One on tipping points. I think it's important to realize that there are two different types. One are the fundamental climate tipping points that might make the shocks more severe and amplified. And the second are the economic tipping points that would be common, say, in the financial stability literature, the amplifiers. It's not just whether my house gets destroyed in a hurricane, it's whether the infrastructure gets destroyed, the bridge, what happens when there's migration or relocation of economic activity. And these are much harder to model. And I think that's where the microprudential supervisors can really team up with the macroprudential work to better understand that. The second point on scenario analysis, which was mentioned, it is just so critical to be clear on what your objective is. If your objective is to find a number, what is the dollar value loss in a scenario, then you're tied to a specific scenario. If your goal is to understand what is the heuristic, what is the risk management approach a bank is using to consider scenarios and uncertainty generally, then it matters a lot less whether you get the scenario right. It's how do you process this scenario and incorporate it into the resilience that you're building.
Very clear. I see a question. I knew it was going to happen.
Hi, I'm Elio. I'm from Fleischmann Hillard EU, and my question is, how can we support EU banks in getting them to kind of get better environmental data, when at the same time we're asking a lot less of our EU corporates in terms of not just the thresholds of when they should be reporting, but in the actual granularity of data that they report. Thank you.
You're back to the data question here. Some insight still on this?
Maybe if I
Please.
can make a point. So I'm not saying data is not important, but if I had a wish list for Christmas, I'd much rather ask the question, how can we make sure that we deliver on all of the potential of our single market, we deliver on the roadmap set out in the Draghi report. I think we will achieve so much more if we focus on this and move ahead in this direction. So if I have a wish list for Christmas, I'm going to wish for the Draghi report rather than I'm going to wish for more data.
Well, thank you very much. That gives me 5 seconds now to wrap up. I want to thank all three of you. You did what I hoped you would do, and that is be intellectually honest, speak your minds on something that is clearly very relevant. I liked a lot that I think all of you reminded us what banks are for. Banks are there to finance the economy, to make sure that firms can thrive, can be competitive, can gain the wealth that we all need as a society to work with. Therefore, they need to manage their risks. We are there as supervisors to play our role to make sure that banks do that well. Part of these risks are driven by different drivers, and climate and nature crises are a driver. There are others, but they're also there and they are material. So it's important that banks do that well. And my true hope is, and that is a little bit the hope that, many decades from now we look back to the decade where we actually, with the NGFS, with our expectations, with the TFCR, with all our the conversations that we have had, that we were able, as a system, not just as a supervisor, but as a supervisor together with the banks, as a system to become more resilient, so that banks could actually withstand these risks, take the opportunity to come with it, thrive, and be just as successful in the next century, as you said, as they have been in the century past. Thank you so much.
Thank you.